Hello from the Authors Guild Foundation. We're here for Money Matters, our series on financial literacy for authors and freelancers. Aaron Lowry and Uchechi Kalu will cover investing basics for writers, along with some info about ethical investment options. Thanks to everyone for attending and for submitting questions in advance. Aaron and Uchechi have those, and they have a great talk planned. I'm sure it'll be digestible and understandable, even if you're completely new to investing, completely averse to learning about investing. Normally, these are friendly people who can talk to authors about it. So I'm excited for this. You can add questions in the Q&A box at any time, and we'll have some time at the end of the hour for that. Briefly, the Authors Guild Foundation is the charitable arm of the Authors Guild. The foundation supports all U.S. writers and through free programming like this and through our advocacy efforts across the industry. Thanks, as always, to our donors who make this work possible. And the Authors Guild, if you're unaware, is a 16,000 member association of authors who enjoy benefits like contract reviews and legal advice, as well as website hosting, regional chapter events, and a lot. And now, please welcome our guests, Uchechi Kalu, a Nigerian American writer and financial planner based in Los Angeles. She was a 2024 Paris Olympics Poetry Fellow, and she's writing her first book on the Biafran War and her family's migration to the US. Aaron Lowry, host of this Money Matters series, is the author of the four-part Broke Millennial series of books, including Broke Millennial Takes on Investing. Aaron's been featured in the New York Times, Wall Street Journal, CBS Sunday Morning, CNBC, and The Rachel Ray Show. She's written for the New York Times, USA Today, and as a columnist for Bloomberg Opinion. Finally, I'm now saying this for every event, views expressed by our speakers during our webinars may not reflect the views of the Authors Guild. And Aaron and Uchechi might have little disclaimers of their own about financial advice. Aaron, I'll go ahead and turn it over to you. Thank you.
Thank you so much, Johnny. Wonderful to be back with you all today. Investing is such a fraught topic for so many of us, particularly because it might have been something that was never discussed for you throughout your education or in your home. And all of a sudden, part of aging and growing up is magically having to learn how to handle your own retirement account and do all of these things. And particularly for creatives, we tend to have this mentality of that's not our lane. That's not something that we really focus on. Today, we're hoping to convince you otherwise through a multitude of conversations around investing. But a big thing that we're going to start with is talking about why investing is so important, as well as getting into just a tiny bit of the terminology and the jargons that you need to know in order to start to feel more powerful as an investor. Last thing I will say before we get started, because this is a topic that can get a little bit technical at times and can be, I'll admit, a little confusing at moments, we want to make sure that you know that you can submit questions at any time. We're actually going to pause at the end of certain sections and answer those questions in real time, as opposed to holding all of the questions to the end. So please, if you have a question that comes up, don't wait until the end where we normally do Q&A to submit it. Please submit it right when you think about it, and we can get to addressing those right when it is relevant to the conversation today. So Chechi, do you want to go ahead and talk about why investing is so important?
Yeah, absolutely. And I want to also give another disclaimer. Thanks for that, Johnny. So I am an investment advisor. I do manage investments for my clients. So everything that I talk about here is general educational purposes. It's not a very specific investment advice. Okay. So, but more generally, I think this is such an important question to answer as to why do we invest in the first place? The main reason is that it is really hard to save your way to your financial goals. And I will give a real life example. My mom is like a master saver. Oh my gosh. She was a teacher for 40 years. And so you can imagine that she did not earn a lot of money, but she saved that money over a long period of time, but she rarely invested that money. So toward the end of her retirement, or rather to the end of her teaching career, she actually had a lot of money, as we might describe it, but really not enough to truly retire. We're just so lucky that she has a pension because like she's old enough to have that, right? So a lot of people can actually be incredibly diligent and save, but if you, I think in her case, maybe she had like 200, $300,000 at the end, was like, well, you're still in your 60s. That might not take you to the end of your life, right? Whereas investing can really take you over the notch. So we're going to show you, I just want to show you what this means. what investing can do versus what saving can do. And I'm going to share my screen and show you this chart. Okay. So at the top here, and also I'm not endorsing NerdWallet. They're just, if you type in compounding interest calculator, they're one of the first that will show up. So when you invest, what happens is that the interest compounds. And rather than trying to just know what that means, I'm just going to show you what that means. So what you're seeing here, imagine that it's a savings account. Let's say that you already have $5,000 in your savings account, and every year for 5 years, you put $100 a month. Okay. That's the 5 years of growth. And it's not really growing over time. This is estimated rate of return. We're just going to put it as 0. Okay. After 5 years, you would have $11,000. This is what it kind of looks like to save. Now, let's imagine that you had it invested. And from an investment perspective, a moderate investment would have a rate of return that might have 5%. Okay. So you have $5,000 for 5 years at the rate of 5%, and you put in $100 monthly. Let's see what happens to that $11,000. It already becomes $13,000. And you actually didn't do anything differently. You put the money in the market and the interest compounded. Now, this is why we usually tell people to invest their money. And I know some folks will then have a question and say, well, my savings account right now probably has an interest rate of 4 to 5%. Why couldn't I keep it in there for the entire time? The reason is that interest rates fluctuate. So maybe 3 years ago, they were like 1.2%. 15 years ago, they might have been like 15%, right? So you can't really count on a savings account to give you the returns that you need. This is a little technical, but I do want people to understand this, is that when you invest, do you see that difference between what you put in, which is that $11,000, or sorry, $11,400 versus the 13,000? That space, that growth, you're not taxed on it until you take the money out. But if all of this money were in your savings account, it would be taxed at your income tax rate. Okay. And the investment tax rate is actually much, much, much much, much lower. Bernie Sanders would say it's for the millionaires and billionaires. It absolutely is. So, on a really high level, this is why we invest. Money grows faster, and it really, really benefits you.
I also want to point out, when we talk about those savings accounts that are earning 3%, 4%, 5%, those are high yield. If everybody tuning in, anybody watching this in the future, please go and check what the interest rate, or the APY, annual percentage yield, is on your savings account, because there are a lot of banks with names that you definitely know, with branches probably on the corner or in your neighborhood or in your community, that offer 0.01%, 0.03%. So you might not even be coming close to the 3%, 4% that you possibly could be earning. So it is very important to know how much you actually are earning in interest on that money that's in savings. Because of course, some of your money should always be in savings. That is a very healthy, important part of a financial plan. But we're going to really double down on this example about investing versus saving. The little example here from me. Just give me one moment to pull it up. All right, so I'd like you to meet Leslie. Leslie is 35 years old. This is just the example. I don't want it spiraling anybody about where Leslie is, or the fact that Leslie has 35 years until retirement. We can get into the age diversification of planning for retirement and investing to big financial goals. But for this example, this is Leslie. She is 35 years old. Her goal is to have $1 million by the time she is 70. She currently already has $100,000 in her IRA. And so she has $900,000 to go with 35 years left. Now, if Leslie wanted to simply save her way to $900,000 more, so that full million, well, she could technically do it depending on her income, because if you do $900,000 divided by 35 years, that's almost $26,000 a year that Leslie would need to save in order to achieve that goal. Or really $2,142 a month for 35 years, which is a huge sum of money to be saving. Now, if Leslie invested that money, she could start with just that $100,000 that she has in that IRA at 35. And if she never contributed another penny and received an average 7% return on her investments, then she would actually hit her $1 million goal by the age of 70. So $100,000 at 35, if she had a 7% return, she'd hit her goal with never having to invest another penny. Now, of course, maybe that won't happen. What if she doesn't get that 7% return? What if she only got a 5% return on average? Well, even if she never contributed more money, she would still hit over $500,000 in that IRA. But let's say that instead she decided to put $420 a month for those 35 years into her IRA. She would still then have over $1 million. So just $420 a month for those 35 years. If she's at 5%, she's still going to achieve her goal. And the reason I say all of this is because investing $420 a month is a huge difference compared to having to save $2,142 a month. And again, that $420 a month, that's assuming a fairly low return on investment, a 5% return. For a lot of people, they could see a 7%, even higher. So then she'd have even more than that $1 million net worth that she's trying to get. The real big takeaway we want you all to have here is that investing does some of that heavy lifting for you. You absolutely could avoid investing your entire life and simply save, but you're just going to have to save a whole lot more money to achieve the same goal. All right, before we move on to anything else, let's address any questions that we might have right now. I know one that's coming in is a little bit more about the technical side of investing, the difference between index funds, mutual funds, other forms of investments. We are actually going to get to some of that stuff. Yeah. So I love that you're jumping ahead, but that is something we'll be discussing. Uchechi, I'll let you start actually on that first one about the TIAA.
Yeah. The question is, what are the type of investments you'd recommend so that they do not evaporate, like 1/3 of someone's retirement in TIAA investments? Okay. So what you're asking is, if there is something like a recession, how do I sort of stave off, or how do I protect, quote unquote, protect my investments? This is a really good question, and it's good to think about what the market is, what it's doing. So if you want to maintain the value of your money, just the number on the screen, keeping it in cash will do that, because there's not really much risk, right? You're not going to see fluctuations of going up and going down. But anytime your money is invested, you are going to see those fluctuations. And those fluctuations are actually what help grow your money over time. When there is a huge market event, like not just a recession, but a great recession, a great depression, a collapse of an industry like the tech industry of the 1990s, when something like this huge happens, it is very, very difficult for folks really across the board not to be affected because of the reach of how those investments are affecting people's lives, right? But there are things that you can do, and we're going to talk about it in the next section. We're going to talk about the word diversification. So whoever asks this question, I want you to kind of hone in when we have that conversation. Another thing we're going to talk about in the next section that can be really important for you is going to be called asset allocation. Okay. But on a large level, what that just means is that if you don't keep all your eggs in one basket, if you don't have super concentrated positions, you only invest in Apple, only invest in American companies. This is what I see more often, is that people are like, I just want to invest in American companies. Like, I believe in America, right? Then when something happens, their investments sort of fall at the bottom, right? So when you diversify across the board, it becomes a lot more safe. I'm going to really use this word in quotations, there is no safety, but it becomes a lot more safe. And when you have an appropriate amount of stocks and bonds in your account, according to your age and your needs and when you need the money, this helps as well. But I never want to tell anyone that they will not be affected. You may be affected if something is happening on such a large scale. It's probably affecting everyone.
That's so true. And I think the other thing to remember about the cash component is that, yes, if you just save your money and keep it in cash, it is quote unquote protected, but you are probably losing value on it because it likely is not keeping pace with inflation.
Absolutely true.
So, as we all know, we were actually talking about the show Gilded Age before
Yeah.
we got on here. And no spoilers really, but somebody receives a large sum of money in the third season. He gets $300,000, which is a life changing sum of money even today. But I
Hmm.
immediately wanted to look up, okay, well, in this, 1870s, 17, in what year are we talking? I realized I should have.
I think it's like 1880s. I feel like they're about to be turn of the century or so.
So I looked up the year that they had mentioned and did the inflation calculator. There are plenty of those online
Yeah.
too, to see how much that would be worth today, and it would be worth over $7 million. And I just bring up the 300,000 compared to 7 million example because obviously it's not going to be that dramatic in our lifetime, but the amount that $20 could value in 1995 compared to
Oh,
2025 is pretty significant. You go to a New York City coffee shop, get two lattes and a pastry, you're at $20 easy.
yes.
And that's with no alternative milks. So it is
Right.
it is really important also just to remember cash might feel safe, but that doesn't necessarily mean it's as safe as you are perceiving it to be.
Yes.
All
Yes.
right. We're going to move on to talking a little bit about basic investing jargon. We're going to start, we've covered compound interest. Do you feel any need to elaborate further on compound interest as a term?
No, I would say play around like when this is done, play around with calculators. I find when I'm working with clients that just the visualization of like, oh my gosh, could this happen? This is what's happening is more powerful than like breaking down this term. So go play with it. That's actually my advice for that one.
Right. Well, let's talk about stocks versus bonds.
Okay. So, this is so important, and I'm going to tie it into someone else's question also about mutual funds, index funds, things like that. So, a stock is an ownership in a company. So, if you own Apple stock, you actually are a partial owner in Apple. You have to own a lot of stock to actually have some play, right? To actually have some say in the company itself. But a stock is an ownership in a company. Stocks tend to have a lot more volatility. They go up, they go down, they go up, they go down. This helps with the growth of your overall portfolio, as we'd say, or your money. Okay. A bond is actually a kind of like a loan that you take out from a company. And so bonds tend to be a bit more steady in terms of the returns that you'll get from bonds. And so when we put them together, in a portfolio, we'd want there to be stocks so that we get the ups and downs. We really get to take advantage of the growth of the market. But then we have the bonds so that we have some like stability at the same time. So they really play a role together. Um, you might be someone that has all stocks in your portfolio or all bonds in your portfolio, and you might want to try and evaluate whether that's really necessary. Someone also asked, what are mutual funds? What are index funds? So anytime you hear a fund, think of a basket, okay? And inside this basket are different types of companies. And different kinds of either stocks or bonds, okay? They might be technology stocks, they might be agricultural stocks, they might be bonds from like municipalities, they might be bonds from the federal government, right? They go into these funds. The reason why these funds exist is to make it easier for you to invest across the spectrum. We're going to talk about diversification in a second. But make it easier for you to not have to think, oh, what company should I invest in? Which bond should I take? You get it all at once. Um, I would say one of the main differences between index funds and mutual funds tends to be speed. You can more quickly buy and sell an index fund. Sometimes they're called ETFs. You might find that more quickly buy and sell them than a mutual fund. But the essence of what they are, that basket of stocks and bonds, is the same kind of across the board.
And they really help with diversification, which is one of the most important pieces of investing. And I want to reiterate, tying it back to that previous question about what about people who lost a huge chunk of their retirement portfolio, of their net worth, of their wealth when big banks failed? back during the Great Recession. Obviously, that has happened multiple times for people over the many years that the stock market has existed. And in part because it is important to recognize diversification is a key, I would say, one of the most important cornerstones of your overall investment strategy. It is, in simplest terms, don't put your eggs in one basket. But what that means from an investing perspective is that you need to understand that the stock market has 11 main sectors. So all of these different companies are categorized by the stock market into 11 big groups. So we're talking about things like energy, communication services, healthcare, financials, real estate. So there are 11 of them that you need to know about. Now, if you were to buy, and I'm going to use names of defunct companies for emphasis here, and also so that I'm not endorsing anybody. But let's say that at one point in time, you put your money into a company known as Enron, and you had all of your money. Maybe you worked for them, and your entire retirement portfolio was just Enron stock because huge company, people believed it too big to fail. This becomes a theme. And when it did fail, the problem with having all of your money in one company is then you're completely tapped. You're done because that company failed. But it was also all just in the energy sector. So you had all your money in one company in one sector. Now, what if you had your money in Enron, and then you also had bought in Ask Jeeves back when that IPO'd before the dot-com bubble burst? Well, now we're balancing out to technology. And what if you also invested in Lehman Brothers? Then you were also in the financials section. Now, I feel like also me naming all of these big American companies that have failed can cause a bit of stress for people. But the point is, all of those happened in very different timelines. If you lost money in one, you were not simultaneously losing money in all of them. But the fact that if you were diversified out where only 5% or 10% was in one industry that was failing or in one company that was failing, that meant the rest of your portfolio might still take a bit of a dip, because generally if one industry is really struggling, the whole stock market is probably going to go down a little bit, but it will rebound. A huge thing that's also important to remember is that when people panic sell and jump out, it's very hard to figure out when to jump back in. And you tend to then lock in your losses. That's a whole complicated secondary conversation. But I do just really want to reiterate that you can do things like buy into an index fund or buy into a mutual fund where you have a lot of exposure and diversification across sectors, across companies, because you as an individual should not be sitting here picking, I'm going to do this company, this one company, this second company, this third company, this fourth company. We want you in dozens, if not hundreds of companies in order to be well diversified.
Yeah, and I'll just add, I want to speak to that. That can be a really real fear that folks have of like what happens to all my money. Like my dad is a relatively older guy, and he worked for a municipality, did not have a lot of control over his retirement, and a lot of it did disappear in that Great Recession, right? I had a client who, when they were younger, a lot of their retirement was in Enron. And so this is why I want folks to actually kind of open their eyes, look under the hood, see what's going on so that you can make decisions for yourself. What happens very often is that, when you go to your HR department, when you first become an employee and they say, check these boxes and you do it, and the investment thing, you're like, okay, someone just press a button, right? And you don't even look at it again. That happens so much. But because of that, when there are these recessions, you're like, oh my gosh, I wasn't diversified. Oh my gosh, I didn't know what I was doing. And then you're so heavily affected. So I just want you to be more aware of what you do have going on. The next part that is so important is what we call asset allocation. And just to break that down is, people will be like, all right, I'll tell you what doesn't work. Someone will say, I need to make $100,000 in the next 5 years because I'm going to retire and that's how much I need. So let's put all my money in the most aggressive stocks, right? And this doesn't quite work because investing is not like gambling. And anytime you're going to get in a really aggressive return, it likely could just be a scam, right? But philosophically, why we don't invest in this way is that when you are closer to the time when you need the money, we actually want there to be less fluctuations, right? Because let's say that the day before you need the money, it tanks because it's all in stocks. You're like, well, what the heck, right? So the closer that you get, asset allocation means that the closer that you get to the day that you need the money, this tends to be the case. It's not everyone, but it just tends to be the case. You're going to want more of your money to be in cash or to be in bonds to sort of steady out the fluctuations. But the further away you are from when you need the money, you tend to actually want it to be more in stocks. And so when I'm talking to people, I want them to think, if you were right now listening to this and you were in your 30s, go look at your investment accounts if you have them. If they are mostly cash, think about doing something differently because time is on your side. But then I would also challenge, let's say that you are 60 right now, but you know that you're probably not going to retire until 75. You still have 15 years, right? Like, I want you to think about like when you really, really would stop working. And then you might allocate things accordingly. But you can also use it if you're building a fund for buying a home, or if you're saving for X or saving for Y. Think about the date that you will actually need that money, and then you can choose how to invest that money. But if you don't want to do this, here's an option. There are companies called robo advisors, and they legitimately do all the things that an advisor would do, like myself, like an investment advisor would do. Some of them are called Betterment, there's Wealthfront, there's SoFi. You can just look online and look for um, the most common wealth advisors or robo advisors. And they will, through a series of questions, they will implement every single piece of advice and education that we've given you here just by a click of a button. And I know someone in the comments mentioned that they felt that planners have higher fees. Like, yes, when you work with a human being who can look at your case and look at it really uniquely and give you a full-on financial plan and give you ongoing advice and support as your life changes, there is a fee for that. Sometimes there are high asset requirements. I personally don't have them, but other people do, and that's how they run their business. So if you're looking for a more affordable option, then I would suggest the robo advisors. If you definitely need a person, I would suggest talking to a person. Erin, do you want to add anything?
And I would just say, too, the term brokerage is something that you're going to hear referenced and come up. That simply just refers to a company that helps you invest, not necessarily even that you have to work with an advisor. You can go to companies. I'm just going to name some names. These are not endorsements, just for information. Fidelity, Vanguard, Charles Schwab, those are examples of brokerages. You could just go to their websites. You could say, I want to open up an IRA, and you could get it done. You don't even need to speak to a person, but they do all have customer service. So if you get confused or get stressed, pick up that phone and call someone as well. And another thing, too, with one of the questions that came in, there was a question about euros and looking like investing in euros. I'm not going to actually speak to investing when you are abroad. However, I will say that one thing I failed to reference in the diversification conversation is diversification also includes investing outside of your country. So if you are only investing in the United States, you also are not well diversified. You need to make sure to be investing in the markets of countries as well, because not all countries do great at the same time. And if one is going through a little bit of a trying time, and that could be for political reasons, that could be for, there could have been a natural disaster that happened in that region and that caused some sort of financial chaos. So again, there are mutual funds and index funds that can also have you invested into international funds as well. So just a really important part on diversification. Another question, too, regarding diversification is, what is your opinion on investing in real estate as part of a diversified portfolio? Not stocks and bonds related to real estate, but actual buying of land or rental properties. I have no negative feelings about it. I personally don't want to deal with being a landlord, but that's an entirely different thing. I think it's important to consider, if you are going to invest in real estate as part of your overall investment strategy, that doesn't mean your primary residence. I personally don't really consider that an investment in the sense of the way you would think about the stock market. Now, once you get into rental properties, That does kind of create a similar possibility for cash flow, but it also could be a bit higher stress depending on how hands-on you are. It could be expensive when those repairs happen. If a natural disaster happens in that region, again, how much cost of insurance can change. Hiring good contractors, legitimate people, having good tenants. There are certainly still risks associated, but it's another way that people can build wealth. There is not just one right way.
Yeah.
And a lot of it has to do with your risk tolerance.
Yeah, and your energy. I will say, if you talk to a lot of certified financial planners, they'll be like, "Don't do it." There is some things in the industry that will just be like, "Don't do it," whatever. But I've also seen real estate portfolios be incredibly important and significant to clients' overall net worth. But there are a lot of costs that, as Aaron was mentioning, that are invisible costs. So if you are going to go into it, make sure that you're like, okay, I'm going to really give this the full time and energy that it needs. I'm going to focus on this for the next 2, 3, 4 years as I figure out how to really make this work. I think what happens very often is that you'll see something on YouTube, or you'll see a reel or something on Instagram or wherever you are online, and someone's like, "I have this huge empire." You're like, "Oh my God, how do I get an empire?" Right? So just be mindful. Some things to look out for. This person mentioned land. Land does not necessarily really appreciate in value and is very, very difficult to sell. Other things to know is that the growth of real estate, I mean, we've seen some extreme growth in the past few years due to COVID, um and I'll also give you an example. I was just back home visiting my parents, and there was a house in the street that was for sale. So I looked it up online because I'm a millennial. I'm like, okay, how much did things really cost when they bought it? And this house cost $4,500 when it was bought, and it was being sold for $300,000. I immediately lost my mind, right? But this huge gap that you're seeing is kind of a phenomenon that it does not seem that it's going to reoccur. So if you're engaging in real estate with the idea that you're going to have this mass appreciation, um, it may likely not happen. So I just want you to be aware of that. On average, real estate also appreciates kind of at the rate of inflation. So like 3.3% or so. That's what you should expect. Now, if you do that on a massive scale over a very long period of time and you commit, it can be great. The last thing I will mention that is that real estate can be a great utility when you're no longer working, because rent can always increase. So always having a place to go home, or a place that like, I can live here, I could die here, and I don't have to ask anyone any questions. It can actually be really, really, really important to someone's financial plan. So just to, make it more complicated. It's not a yes or no answer, but it can play a really important role. So consider it wisely.
And I think it's important to keep in mind that sometimes people position real estate as the safer option compared to investing in the stock market. But I think that's incredibly short sighted when we just look back at the Great Recession. Real estate was a contributing factor, and many people lost their entire net worth because it was all tied up in their home. So it is really important to remember that that can also be volatile and also be fickle, and it is not necessarily a high guaranteed return. There is a level of risk in almost any choice that you're going to make when it comes to investing. All right, speaking of, we're going to get to one of my favorite stump speeches, which is saving for retirement versus investing for retirement. I'm going to keep this really tight to make sure that we can get to all the important conversations around ethical investing and open up for your questions as well, and have a little bit of conversation about how to hire a financial planner, what that looks like. But we were asked earlier, how should you start investing? Mutual funds? Question mark. Yeah, that's an option. But one thing I think people constantly overlook is that if you have a retirement account, an IRA, a 401k, a SEP IRA, a solo 401k, I'm not going to name every single option, but if you have a retirement vehicle set up and you are contributing to it, you're an investor. You're investing with one very important distinction. Now, we use the term save for retirement. It's a misnomer. I hate that we do it. I hate that that's the language that gets used, because you should be investing for retirement. And the reason I hate it is because sometimes it confuses people. They think if they just set up that account and just contribute money to it, they're just doing the right thing. That's it. They're done. They have that 401k, that IRA, they have that automated contribution set up. They're good to go. When you set up any of these retirement vehicles, it is important to make sure that you actually set up investments to have your money go into, because there are people for whom they set it up and then it sits in cash. And then the question is always, how do I know whether or not my money is sitting in cash? If you log in to your account and look, it'll be pretty simple where it says, like, it'll say cash fund, money market fund, settlement fund. These are all terms that get used to basically mean your money is sitting in cash. You can also call up customer service and ask. Someone can easily let you know whether or not you've actually selected investments or whether or not it's sitting in cash. If it is sitting in cash, you basically are just saving. You are not actually investing. I do want to make sure that you are actually investing your money that you are setting aside for retirement. So if there is one huge takeaway you take from this, it is to please go check your retirement account and see if that money is actually invested. Another really easy way to tell, has there been any change over the last year, 2 years, 3 years? The stock market has done some volatile things, so you should see some ups and downs. If it's just kind of pretty steady, it's probably sitting in cash. So just everybody make sure that you check that. I will also give one piece of advice. For those of you who have a traditional job, your company might auto enroll you into investments. So even if you didn't select them, there are some companies, brokerages that are set up to auto enroll new participants. That's great. Oftentimes it goes into something known as a target date fund. This is a fund that is essentially going to pick your asset allocation based on your age. So when you're young, when you first sign up, they're going to ask, like, basically, what year do you want to retire? They're assuming you're tying that to like 65 or 70, not being optimistic and being like, I want to retire at 45. So let's say that hypothetically you put in the year 2050 and you're in a target date fund that is usually called something like Target Date Fund 2050. In the beginning, it'll be more aggressive. Then as you get closer to that year, it'll go more moderate, and then it will go more conservative. If you just want to make sure your money is invested and you currently don't have the bandwidth to learn more about investing or don't feel ready to hire a financial planner, there's nothing wrong with using a target date fund. It might be a little bit more expensive than building your own model. The one big downside is it is a one-size-fits-all solution. It's not really addressing anything specific to you, your values, your plan about when you want to retire, your exact risk tolerance. But it is a way to make sure that your money is invested, especially for people who currently do not have a lot of information about investing, might feel a little overwhelmed by it, and aren't quite ready to hire a professional. But as you learn more, you could also just build your own fund or hire somebody to help you.
Yes, and I'll just say I've seen many and many and many retirement accounts that were actually in cash. And that to me is like so devastating because folks are so diligent about saving. Um, so we're going to talk about values aligned investing. Sometimes you call it, you hear it called ethical investing or social justice investing. And I'm going to kind of give it to you straight. I used to work for a company for many years where this was all that we did. Every single kind of portfolio that we offered was under this realm, under this lens of being ethical in some kind of way, being environmentally friendly in some kind of way, or good for the world. And I get it because very often folks come to me, or clients come to me, or prospects come to me and say, well, how can I like do good? The world seems bad. Companies seem bad. How can I be good? And how can I do good or be good without sacrificing returns? Like, I still want my money to grow. And to be honest with you, for the average investor, I have not, in my professional experience, found this to be possible. The reason being, and there, a lot of people in the industry might have a very different opinion on this. This is my professional opinion. Is that if you take a fund, maybe it's called an ESG fund or a green fund, and you really look under the hood and see what's inside, you're almost always going to see Apple. You're going to see Google. You're going to see Meta, RIP Facebook. You're going to see X. You're going to see Tesla. You're going to see all these companies that when you really ask yourself, you're like, huh, if Google is also now an AI company and they're draining water from all around the world, could this really be an environmentally friendly fund? You will ask yourself a lot of questions, okay? And I really have not encountered a fund that's really available to the public markets where you're not going to be scratching your head a little bit as to how some of the companies that are included in that investment could be considered ethical or could be considered good or good for the environment. And so when you hear that term greenwashing, this is really what it's harking on, is that we want to feel good as human beings, and so the industry created products that we could feel good about. Now, there are some things that you can absolutely exclude from investments. These are things like tobacco can be excluded. And the reasons why is that it's just very easy to track certain things. Private prisons can be excluded, oil and gas can be excluded. Um, even palm oil can be excluded. But it's really hard to exclude like child labor. Very, very difficult. So I just always want to tell people, if you're battling with this, you're going to continue to battle with it. But if we kind of hark back to the very beginning, the point of investing is at least to beat inflation, is at least to beat, like, to really grow your wealth, at least to cover your expenses as you age. And that's really the best that we can do. A lot of companies do a lot of different things. Like Boeing is a company that we fly planes with. It also is a contractor with the Department of War, as it's now called. So what do we do about that, right? You are going to be conflicted, and I've never found a way not to. But some things that you can do, I think that these are things that you have to do outside of your investments. One is actually getting involved in your community, like where you are locally. I live in LA. Like, a lot of people live on the streets in Los Angeles. There's so many issues with immigration and deportation right now. If that is what's important to you, go out into the streets and help people. I think that's more important than the idea of like trickle down economics, like you put your money in a good fund and suddenly there's a tree somewhere. I don't really think it happens like that. The other things that you can do, you can divest and you can boycott. This is very, very strong and very old school. But there are companies like Target, which, was such a big company, but RIP Target, who knows what's going to happen to those guys, right? So when people come together and make decisions as to how they're going to spend their money, it does actually affect businesses. It does actually affect capitalism. So these are the places where, if you want to be more values aligned, you want to make more ethical decisions that you feel can actually impact a life, maybe even change a life or change the status quo. Think about divestment, think about boycotting, think about leaving your house and go helping someone out there on the streets. I'm going to pause there for any questions that might have emerged.
Well, one that had been brought up previously was the future of green funds, which you, I feel like, very astutely have made a great point. And I do want to just add one quick thing on divestment. If the other thing to think about is the power of the collective, in terms of, if you are part of an institution or went to an institution that you want to coalesce a group of people to try to push. College endowments are a really good example for them to divest from certain things. That's a great way to make a change, but doesn't have to do with your specific investment portfolio. But it really does move the needle because it's on a huge financial scale, as opposed to us as the individual consumer as well. Now, this is not specifically tied to ethical investing in the sense of SRIs and ESG funds, but it is in terms of being an ethical leader of some steward of someone's money, and that is how to avoid the Bernie Madoff phenomenon. So I'm just going to say one of my thoughts, and then I want Uchechi, as the actual financial planner, to also lead in. My first thing is to always be skeptical a little bit. When you hire somebody, you want to trust them. You want to believe that they're doing the right thing. But if they're having just astonishing returns quarter after quarter, year after year, especially if they're consistently beating the market to such a degree that it seems too good to be true.
Mm.
It probably is. There really isn't anybody who can consistently beat the stock market by massive percentage points without doing something that is very questionable at best. Are there outliers from time to time for maybe a year or two? Sure, of course. But if somebody just is very consistently outperforming in a way that is incredibly notable, you do need to be really cautious and careful and ask a lot of questions. And it's also important to understand how your money is being invested. If your financial planner, advisor, investment professional is talking down to you, kind of talking to you as if like, don't worry about it. That's what you hired me for. Don't worry about it. And they're not willing to answer your questions. That should be a huge red flag.
Mm. Yes. Um, yeah, I think that there are a few ways to go about this process. One is that you can work with a certified financial planner. I do want to give a caveat in that I know a lot of advisors who are not CFPs, and they are incredible, actually, really, really, really incredible. Um, I have a bias in that I am a CFP, but I don't like if you are working with someone right now and someone that you love and that you trust and that you respect. I just want you to know that I'm not disrespecting them and what I'm going to say. Um, the great thing about finding a CFP is that we have to abide by a law of ethics. And, if I do something that you think is not ethical, you could report me to that ethics committee who then would revoke um my letters, right? So we're constantly thinking, and we have to put our clients first. We have to be as objective as possible. We cannot do nefarious Bernie Madoff-ish things and think that we're going to get away with it. It's really not possible at all. But when you're working or looking for an advisor, look for someone who asks you questions about yourself. Like that one. An advisor really should be kind of like if you got a new therapist, because we do, I think, tend to do a lot of therapy with clients. Like you want the therapist who isn't just being like, you gotta go do this, you gotta do that. Someone who like wants to know what's happening in your life, what's important to you. And if that advisor is someone who can prioritize what's important to you, they very likely are coming from the right place. Also know that like your money is your money. Very often folks will come and they'll be like, okay, like so you're gonna take my money and then you're gonna do something with my money. And I'm like, no, 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 it's your money, right? It is never my money. So if you want to get up and go, you get to get up and go. Like very often people work with an advisor and they don't even like them, but they don't leave because they don't feel like they can leave. Just know that you have that choice.
Also, when it comes to looking for an advisor, definitely somebody that you can connect with, that you feel heard by, but make sure you research them too. One of my favorite tools, and I speak for Chechi as well, is something called Broker Check. It is from
Oh
FINRA,
yeah.
FINRA. And interestingly enough, that somebody else already name dropped him. But my recommendation is always just to be like, hey, if you want to just test it to see how Broker Check works, you go to the website, and if you put in the name Bernard Madoff, it will come up with the fact that obviously no longer was allowed to practice and to be a financial advisor, but all of the infractions and all of the crimes. So the thing that's great about Broker Check is that you can always, it's kind of a way to do a background check on what somebody is telling you about being a financial advisor. You can make sure that all the certifications they claim to have are in good standing, that their ethics are in good standing, that there are no open claims against them. So
Yeah.
that's just one way to also do your own research and be prepared.
Yeah. Like if you type in my name, like you can do it right now, like Uchechi Kalu, you will see green light financial planning. Like, and that is even I didn't know that before becoming an advisor, but then now I creep on people and I see what's going on.
And we were also just asked, can you explain what it means for an advisor to be a fiduciary? Is that something we should specifically look for?
Yeah, so a fiduciary is someone who it is their job to work in your best interest and not necessarily in their interest. Now, um, there's a fiduciary standard, and then there's the I believe it's called the
Suitability.
suitability standard. Yeah. So very often with suitability standard, you'll find an advisor who is and no shade to them, but who is selling you a product. So as a CFP, when you hire me, you're hiring me to give you advice. Like your financial bestie giving you advice to run analysis to do the math for you. But I personally am not going to sell you a product. I do not earn a commission on it. Um, I I don't do any of that. There are advisors who that is how they make money. They sell you a product that they believe is suitable for you, and it also might be quite suitable for them based on the fees that they get from it. So that's the difference. Again, I know people who are not necessarily fiduciaries, but I do respect them. But you might want to work with a fiduciary, I would say, at the
I
core.
also want to remind everybody certified financial planners are required to be fiduciaries. That's
Yes.
part of their job. And personally, again, there are people who have a multitude of ways of earning money from their clients. But I personally think it's nice and clean when it's a fee only financial planner. So you give them a sum of money and they help your financial plan. Now, there are some people who do a mix where they also could receive commission. You just need to make sure you understand when that is happening and how you feel about that product. So just understanding, follow the money is kind of always the answer to questions. So when it
Yeah.
comes to how somebody earns money, especially if they're working with your money, understand how they're earning that living. And I know we had a question come in earlier about assets under management, AUM. That
Yeah.
is one way that some financial advisors earn a living. And sometimes, like you mentioned earlier, they might have a minimum net worth. But there
Hmm.
are so many who have a much lower fee, do
Yeah.
not operate with assets under management, don't charge you a percentage of your overall portfolio as their fee, and do not have net worth minimums. If you want to share where maybe people could go to look for those
Yeah.
financial planners.
Exactly. So if you're looking for a certified financial planner, and we're going to have this in the follow-up email, go to letsmakeaplan.org, and it's the database that has all CFPs that are in the US. It also means that they have a part on it where if someone tells you they're a CFP and you're like, oh, but are you? You can type in their name and see if they show up. And so some clients are looking for investment advisors, some clients aren't. Some people just want like a one-time engagement. Sometimes they're not. Sometimes you're looking for a man of a specific background, a woman of a specific background. If you're queer, if you're neurodivergent, like go on there and see the kind of person that you would want to work with because it is a very personal and emotional relationship. So it should be someone that you trust.
And I do think it's really important to emphasize again, you don't have to hire a financial professional to invest. I just do want to make sure
Yeah.
we're reiterating that.
Yes,
If
absolutely.
you want to use a robo advisor or just go to a brokerage by yourself, pick your own investments, pick your own funds, build your retirement plan yourself. Again, reminder, you are an investor. If you just have that 401k or IRA or 457 or whatever it is,
Mhm.
you still are investing. Compound interest is still working for you as long as it's not sitting in cash.
Yeah.
So you do not have to hire a professional, but you might reach a point in your career or in your net worth, or you might have a life incident, whether it is receiving an inheritance, getting married, getting divorced, having a baby. There just might be a time in your life where you want somebody's help, a little bit of guidance, and to hire a professional. Again, it's great if it's an enduring relationship. It might also
Yeah.
kind of be a tune up if that's what you need.
Exactly. Like sometimes I meet folks who just want someone to tell them that they're okay. Like, can you look at this and tell me that I'm doing okay, right? So like be creative. It doesn't have to be like an ongoing thing. But we have a few questions. I think we can answer them. Um, the first one is okay, is do robo advisors have an incentive to constantly trade in order to earn money? Um, I can't answer this question for every firm. I will say, and again, I have no skin in the game. You can work with whoever you want to. I started using Betterment when I was like 20 years old. I was living in China, and I was like, how do I like do this American wealth thing? So I started using Betterment since then, and I don't think I have ever experienced this. I would say on top of that, call them. Call them and ask them that question, actually. If you like really are concerned about this, call them, ask them that question, and have them like go over the statement with you to see like what is just the fee, whatever that low fee is, and then what is additional, and if you think that that is justified or not. They'll be able to talk to you about that. The next one is talking about continuing with the 457 versus transferring funds to other investment accounts like Fidelity. I think a really good rule of thumb, a 457 account, for those that don't know, it's a type of retirement account. So a really good rule of thumb is to like at least get the employer match for your retirement account. And then if you have additional funds, you might want to allocate it to other accounts depending on when you need that money and like what it's for. I can't tell you specifically because I don't have enough context, but a lot of people will have money that is in pre-tax accounts, like a 457, and then post-tax, because the post-tax money is money that you actually can access now, whereas a 457, you can only access it without a penalty when you're 55 and a half or 59 and a half. Sorry, go ahead, Erin.
The other thing, though, I will add, because I'm not sure which direction this question is going. If the other one is like maybe you left your job where you had the 457 and you're thinking about rolling it over, I personally am a big fan of the rollover. All that means is that let's say you were at one employer, you had a 401k with them, you get a new job. You could, depending on the rules, leave your 401k hanging out there with your old employer, start a new one at your new employer, and now you have two 401ks in two different places. I love a rollover. Bring that 401k along with you. You can move it into an IRA. You could move it into your new employer's 401k, again, depending on their rules. But I like when people keep their money with them because especially if you end up being a job hopper, and then in the future, you're trying to go back like 15, 20 years to a job you had when you were 32. And you're like, wait, what was the login? Where was this money? What was this account?
Yeah.
Just keep it coming with you. And then you also can just see it fattening up all in one nice account together.
Yeah. And it will compound faster the larger the amount is, actually.
Yeah.
Yeah.
That benefit too.
Yeah. Yeah. Jan asked about how do you divest and boycott while remaining invested? That's the part. The divest and boycott I see is an actual boots on the ground. Like you like leave your house, you do something, or you don't do something in your active life. Being invested in mutual funds where you don't have any control is like where we all are stuck. Yeah. Oh, we don't even have time to talk about annuities. I'm so sorry, Ronnie. Best advice for someone who is self-investing through an online brokerage. I'm not sure what advice would be as helpful, but honestly, if you would get a professional to look at what you have and just tell you to keep going or make a tweak, that would be my best advice because I find very often that people are making, I think, amazing decisions all the time for themselves. And yet there's like a choice, like a small choice that they can make that could have a huge impact, but you don't know about it because you weren't a professional.
I would also just throw in be consistent. You know, if you're having to handle your investments yourself, particularly as a creative, particularly if you're self employed, little bits at a time add up. And I know for some of us, it's stressful because our income can be variable. We've done a webinar on investing and paying yourself salaries with variable income, both of which you can find in the resource library. But just being consistent, even with small sums, really adds up over time.
Yes, yes, yes. And to the last question, which is about investment clubs, are they still a thing? Actually, they are. Here in LA, there is a group called Black Women Invest. Like they are an investment club. I'm not saying to necessarily join them, but what I am saying is that one of the best ways to be consistent is to have accountability. So like even in my practice, I use this three wheel that I made up because it's an A on each side because whatever, I'm a writer. And it's you want analysis of your own sort of like of the math. Um, but lastly, you want accountability. Okay. Accountability. And that can come from sorry, there's awareness, that's the emotions, the analysis is the math, and the last is the accountability. Other people are the ones that are going to hold you accountable and not just yourself. So if you don't have a investment club, like ask your friends, ask your partner, ask the people in your community, ask your parents, ask other people to get involved and you'll go faster and further.
Well, thank you all so much for tuning in. This was great. We appreciate all of the very thoughtful questions you submitted. Investing is a heavy lift. You can't cover it all in an hour. We have really enjoyed taking this time with you today, though. Just a reminder again about the Authors Guild Resource Library. We have more conversations that have been had on previous webinars. Go back and check them out. There will also be a great follow-up email with all sorts of resources, too.
Bye, everyone.